Welcome back to Lamb's Cryptoverse. This is the first video that I'm doing on our education series. So I was thinking, what would be the most important concept that I can explain to my subscribers? And it's this one word. No, it's not plastics. This is referring to the 1967, yeah, it's that old, the 67 movie called The Graduate with Dustin Hoffman. So we're going to cross out plastics and replace that with liquidity. And it's this simple. As liquidity gets increased, asset prices go up. So basically, when you lower interest rates, liquidity goes up. That's the key concept. That's a seesaw here. Lower rates, higher liquidity, higher asset prices. But you can't see liquidity. So here I've listed some examples from the past and present. And some of them are concrete examples, some of them are indirect examples, but these are ways of determining and so-called seeing liquidity. The first two I'm going to skip for now. We're going to talk about them later. So let's go to the third one. Rates, as I mentioned earlier. Rising rates, a change in the yield curve. Falling asset prices. It could even be home prices, equity prices, cryptocurrency prices. The TED spread, you remember that? No one talks about that. But in 2008, it was like inflation of today. Everybody was looking at the TED spread, meaning how much risk is there with banks lending to each other. Remember the subprime crisis? It was bad. Credit yields, especially high yields, and the associated refinancing risk. We have a lot of that now. We have, according to Mike Howell over at Cross Borders Capital, he believes we have $60 trillion in global refinancing risk every single year, using an estimate of a 5-year tenure on debt. He gets $60 trillion of debt that has to be refinanced every single year. And more recently, we have dislocations in capital markets. Right now, it's very small. It's just a mortgage-backed securities market. What we are seeing are bankruptcies in capital market entities. And as you can see here, these are crypto-related, such as the hedge fund 3 Arrows Capital, the Voyager Exchange, I should say, centralized exchange, and the Celsius Lending and Borrowing Protocol, which just went bust this week. And more, now we're seeing an emerging markets crisis and even crises in developed countries. Just this week, we saw two resignations, one being Italy and one being Sri Lanka. The two leaders have resigned from their respective countries. So that's showing that liquidity is affecting the global on the big time, let's say. So now I want to focus to what you really need to look at. Remember, I said the only one word you need to look at is liquidity. And now I'm just going to focus on one or two data points that you need to determine liquidity. That's all you need to look at. So let's look at that. The US dollar. I like to use the US dollar because it's global. So the US dollar implicitly tells us what's the status of global liquidity. As you can see here, this is a long-term chart going back to 2001. Global liquidity is declining rapidly. As a matter of fact, it's declining at one of its most rapid rates in history. Now, you're not going to see that if you look at the interest rates or short-term rates or the Fed funds rate. Yes, the Fed funds rate has increased from around 0% to maybe going up to 1.5% to 3% next year. But even that is nothing if you look at global liquidity. It's really declining rapidly. If you look at the US dollar, we're at a 20-year high, including the euro. The euro breached parity, meaning 1-to-1 with the dollar as of this week. And so the US dollar is rising and it's not looking back. It's just going parabolic. Even the Japanese yen, which is a safe haven, is declining at a rapid rate with the dollar. So we're talking about a huge, huge decline in global liquidity. Now, if you want to see an actual number for global liquidity, I've got a nice chart here from Raoul Pal. I think many of you know him from Real Vision, but he also owns another company called GMI, Global Macro Advisors, or Investors, I should say, Global Macro Investors. And he puts out this index. And this index, I like it because it measures financial conditions, which is similar to liquidity, but it measures it going way back to around 1984. And that's the blue line. You could see it's declining. It was high. It was high because of all the stimulus, the over-stimulus from the Federal Reserve beginning in March, April 2020. So we went from declining liquidity to really rapid increase to a state of over liquidity in 2020 and 2021. And now we're declining at a rapid rate. And according to this financial conditions chart, because all the charts are different, we're at the lowest point in liquidity, the worst liquidity since the 2008 crisis. But I've seen other charts of liquidity that show that global liquidity is even worse. Now, Raoul Pal, what he does here is he shows what the ISM index would be based on financial conditions. And right now, the ISM PMI index, the Purchasing Managers Index, is pretty high. It was in the 50s, which is a pretty good number, around 55, and it recently declined to 53. But he thinks it's going to plunge to around 35, 38, something like that. You know, this is not an exact science. But the point of Raoul is that financial conditions are so bad that even though the S&P is down 20% from its high, that it could still keep declining, as well as all other asset prices. They could keep declining. And that includes real estate too, which, remember, real estate is a lagged asset class. So you're not going to see a decline in real estate until maybe 6 months after financial assets. Now, this is another chart of financial conditions. Now, I'm showing this chart. It's a little outdated, but the reason I'm showing this one is because it charts Bitcoin versus financial conditions. And I was told, I was really looking into Bitcoin and cryptocurrency since, I guess it was 2017, 2018. And I didn't understand the cryptocurrency market. I was listening to people like myself that told me over and over again, they banged the hammer on and on, over and over, that cryptocurrency, especially Bitcoin, was its own asset and was not correlated with the market. They were wrong. And they even said that because cryptocurrency prices went up so much that they were not correlated. But what they're not understanding is just because something rises a lot does not mean it's uncorrelated. What you need to do is to look at the asset price when times are tough. And we all know that saying that during down markets, all correlations lead to one, meaning that asset prices of different product types, different asset classes, tend to correlate when times are tough. And if you look here, you can see that when Bitcoin was having problems in 2018, and so was tech stocks, so was the financial index declining. So Bitcoin and all cryptocurrency assets are indeed highly correlated with financial conditions and stock prices. So that's not a new correlation. That's the new narrative now that, oh, Bitcoin is correlated with the NASDAQ. No, it's always been correlated with risk assets. So just keep that in mind. So to conclude, one thing I want to get straight, I want everyone to take it in and understand it. If you don't, please message me or put something in the comments, write a comment. It's this, that liquidity determines everything. Stop worrying about today and think about tomorrow. And here's what I mean. The Fed, sooner or later, is going to have to pivot. They can't just keep raising rates forever. And according to that dot plot, they're going to keep raising rates into 2023. I don't think that's the case. So I'm going to leave it with Wayne Gretzky. He said, I skate to where the puck is going to be, not where it's been. So remember that.